Ladies and gentlemen, welcome back to the channel. Here in this video, I will share with you why I am so bullish on our markets, the potential risks that we have, good and bad, and what could be coming next, where you should position your portfolios. Keep in mind, I am not a financial advisor, I am not a financial planner, but there are some things that we can logically say, like, hey, that's probably a good area to be in. That's probably not a good area to be in. And here in this video, I will share my perspective with you, but keep in mind, again, not a financial advisor. I could be wrong and markets could crash and burn, but that's not what I'm seeing as of right now. Now, first and foremost, as I have explained here on this channel many times before, in the near term, we have more certainty, and human nature just hates uncertainty. We cannot process that, and that's why every aspect of our lives has certainty, okay? When your mortgage payment is due, you know exactly when it's due, you know exactly how long you have after the due date until you get a late fee. You know when you order a pizza, for an example, where the pizza is at in the process. As long as you're doing it online, it'll tell you if they're making it, if it's done, if it's out for delivery. DoorDash, Uber, flights, everything is based around alleviating uncertainty. And I say this to really explain that uncertainty is such a powerful negative catalyst for markets because of the human nature aspect of markets. Yes, 80% of trading volume happens from computers, but or quants. But these quants are also programmed to be fearful around uncertainty. And why I say this is because these reciprocal tariffs, this trade war potential, has been the biggest driver of uncertainty in markets recently, and that's kind of why we've been trading in this trading range. And on Friday, we got a little bit more clarity on what this trade war situation could look like and some guidelines for reciprocal tariffs. Obviously, steel and aluminum have already been tariffed. It looks like cars are going to be tariffed to some extent. It looks like other areas could be tariffed, but it wasn't as bad as feared. And simply, it alleviated some uncertainty. And that's why markets had really rallied over the past 2 days. Thursday, S&P was up over 1%. And on Friday, you were essentially flat, although it does read here a slight gain for Friday's trading day. Now, Friday, the volume was really, really low on markets. And I expect, as we head into next week, volume will pick up. You can see we are in a technical breakout, okay? And anytime you get these technical breakouts where you break above a downtrending trend line, you get a larger rally. You kind of break to a new zone, and then you can consolidate from there, and then ultimately what has happened in recent years is breakout again. Now, I especially think this is true heading into next week because we don't have much for catalyst next week and economic data. We do have the FOMC minutes, you have building permits, and a couple of other smaller things coming out. Initial jobless claims always comes out on Thursday. Keep in mind, markets are closed on Monday, so it is a shorter trading week anyways. And seasonality is really not great for February, but considering we are in this technical breakout, a lot of the uncertainty has gone away, and people are very bearish. I mean, this is like levels you only see during like crashes, okay? Like 2000, you were this bearish. And 2023, coming out of the bear market of 2022. 47.3% of investors are bearish over the next 6 months. 24.3% are neutral over the next 6 months. And only 28.4% are bullish. Normally, when almost nobody's bullish, that's precisely when stock market goes higher. I mean, if you want to get super technical on this, you can think about it this way. You can't have everyone win. So if everyone is bullish, it's very hard for markets to go up. When everyone is bearish, it's very difficult for markets to fall. Think about it in terms of options, right? If you win big on an option, somebody loses big on an option. You can't have everyone win big on an option. That doesn't work. eventually it reverses and you end up going lower. Okay, now that's kind of where we are now. Everyone's bearish, so it's really going to be difficult for markets to fall materially from here. And again, I don't think we have anything to worry about when it comes to tariffs for a while. We just got new information from the Fed and clarity. You can also see that the percent of stocks trading above their 50-day moving average is only at 51.37%. So you are not nearly, to the extent of like an overextended market, as some people think. Yes, if you look at the headline S&P, you did hit a new all-time high on Friday, but there's not a lot of broader participation. This is far from a euphoric market. And you know what they say about bull markets? Bull markets are born on pessimism, they mature on skepticism, and they die on euphoria. And we are far from euphoric. And considering, again, we've just gotten all of our important economic data, PCE, PPI, CPI, retail sales. We've gotten GDP here over the last couple of weeks. We got the Fed. We've gotten your big tech earnings season. I don't think NVIDIA is really going to be a concern. I think what we've heard out of hyperscalers bodes really well for NVIDIA. So I don't think we have that to worry about. I just don't at this point see the catalyst to send markets lower in any kind of dramatic way like some people are calling for, unless, some kind of new shocking, thing comes out. And well, you can't forecast for that, and you certainly can't really trade around that either. Now, I do want to share this clip with you from CNBC. It says, expect 3 to 4 Fed rate cuts this year from 314's Warren Pies. Now, this is someone I think is very intelligent and tends to be correct with a lot of the calls that they make or he makes. This is so out of consensus right now that I think it provides a lot of value, okay? Everyone is saying no cuts this year, maybe 1 cut this year. That's what the bond market is pricing in, 1 cut this year. And he's saying, no, you're going to get 3 to 4 cuts. These are the kinds of clips and interviews that I think are very important and insightful because, who cares? Everyone's saying the same thing. Like, great, we already know that. But someone that offers you a completely different opinion, I think is worth listening to. And while he is overweight tech, he likes markets still, he does say you want to be cautious around April, May or so. That's when the economy could start to weaken a bit further. And especially considering Doge and the government cuts that we are seeing to jobs, it is being reported 250,000 government employees could already be laid off, although we've only got 75,000 that have been affected, have actually took the buyout. There's been, a dramatically higher amount that have just been essentially laid off in the past couple of weeks. And that's one of the arguments he makes, that we could see the economy start to weaken. So take a listen to this. I would love your thoughts down below in the comment section. Seriously, if there is any clip that you watched today that has to do with stocks, let it be this one, because there's very valuable information in this.
A bigger breakout could be in the cards, but I see here that you took your weighting to stocks down a bit. Am I reading that right?
You are, yeah. So we were running an excess long position, and we just neutralized that last week. And so I think the bottom line is it's too early to outright worry, but you need to start looking ahead to some potential risks in this market. And like you said, the market's been in a really tight range. It's 6% plus or minus for the last 3 months. Really, if you go back historically since 1950, this tight of a range only occurs about 13% of the time. And you really need to be patient and watch where the market breaks. And our view is we're going to break out to the upside in the very near term, which is positive. But when we get out to spring, I think you need to start taking some precautions when we get out to spring.
Why are you overweight bonds?
I just don't see. Number one, I think disinflation is going to bite pretty hard this year, and I think that the gist of our concerns out in April are growth concerns, and so I think for the first time in a while, bonds are providing a really nice diversification benefit for your portfolio. You know, I see the consensus that it comes on TV and just out in the financial news in general, and they're saying, you know, no cuts this year. The Fed's going to be on hold all year. I don't think the economy can handle that. I think that the housing market at 7+% mortgage rates doesn't really work, and we're going to see that. Really, it's going to be about April, May when I think those cards are kind of flipped over, and we can see that clearly.
What role are tariffs going to play in all that?
I don't think so. Our view is not that tariffs themselves are a major problem for the economy or the market or for inflation even. But what I see the major impact that tariffs are going to have is on the Fed. So, you know, if we look at last year and this year, you know, we just had this hot inflation report. I think if you dig through it, it's not that bad. We had a very similar residual seasonality last year, the first 3 months of the year, hot inflation. The Fed was very quick to calm everybody down and say, we want to look through this. It was an election year. The Fed was much more prone to cutting last year. I think that the role tariffs plays is it gives the Fed a potential excuse or at least a reason to be less reactive to inflation. So when we go out into April, May, say, why are you so concerned April, May? We have that March Fed meeting. I think that tariffs and the threat of tariffs at that point in time are really going to cause the Fed to continue on this hawkish pattern. And they're going to be doing that at a time where the economy is slowing. Tax receipts are coming in strong. Whenever you have a strong bull market year in the preceding calendar year and you go forward in it's time to pay the tax man, that's usually a weak period for the stock market. So I think all those things come together around April, right after that Fed meeting. So tariffs, I don't see them as a threat in and of themselves. I see them causing the Fed to be more hawkish, though.
More hawkish. But eventually, though, it sounds like you think they're going to have to act. I mean, if the economy is going to slow more dramatically than maybe some people think, and I mean, you're thinking about Doge also, right? If you're going to cut spending that dramatically, you're thinking about growth taking a hit as a result. So a more hawkish Fed turns into a more cutting Fed, though.
Yeah, I mean, like right now, I'd say if you look at the futures market, there's like one cut priced in Fed SEP is like 2 cuts priced in for the year. I think we're going to take the over on that. So I think we're going to have 3 or 4 cuts still this year. And it's really just a matter of how painful it's going to be to get there. You know, if the Fed wants to stay really, what we're calling a recalcitrant Fed, if the Fed wants to stay combative or recalcitrant, then I think it's going to be a tough time for the markets. But ultimately, one way or another, I do think we're going to get cuts. They might not come till the back half of the year, but I'm taking the over. That's part of why we want to be overweight bonds here. I think the Fed cuts 3 times, if not 4, this year.
You want to be overweight or market weight on tech? I mean, there's a pretty good debate, I think, to that question being asked right now.
I want to be overweight personally. You know, I look at this, the growth scary. And so part of deciding what to be overweight is looking out and not making mistakes. And so I want to have interest rate sensitivity in my portfolio. So maybe utilities, interest rate sensitive stocks like that. And I think large cap tech, they've trailed the market here. We've had a broadening out, but ultimately if the market's going to break out and really you want to be bullish, then I think those are going to have to be the leaders still. And I think I have a hard time. You look at where earnings are supposed to come from. You see the big role that semis play, NVIDIA plays. Like those have to be the leaders. If we're going to have double-digit earnings, which I think we will, it's going to have to come from the tech sector still. And so to me, yeah, I want to be overweight tech. It has some defensive characteristics given the growth concerns. I want to be underweight resource stocks in this environment. So I want to be underweight energy. I want to be underweight miners and things like that outside of gold, and stay sort of defensive in my weightings within the market.
Okay, if you tell me that is not the most insightful against the grain argument for markets that you have seen in weeks or months, I mean, I will personally call you crazy. Because when I heard that, and I get a lot of different opinions, I take in a lot of financial information to stay up to date on what's going on in markets. And that's why often I predict things before they happen. You know, if we're about to get a breakout, I'll tell you about it. If we're about to see the markets pull back, I'll tell you about it long before anyone else talks about it, because I stay so up to date with so many different opinions. And this one just really took me back when I heard it, because it's so out of consensus. Now, I've had the same kind of opinion as War Implies for all of 2025 so far. I've never been in the camp of we're only going to get, one cut or no cuts this year. I think inflation is going to dissipate a lot faster than we expect. April, May, June, July, really, after Q1, I think inflation is going to really start to fall. We've, in the past couple of years, seen this phenomena where January, February, March inflation is hot, and then it kind of dissipates throughout the year. I think this time is going to be quite pronounced, with the kind of trade-off to weaker economic activity, especially with Doge and the way that we are now cutting back on government waste and government inefficiencies, and even laying off what looks like 250,000 government employees. That is going to have a drag to economic activity. Okay, it's all interconnected. Okay, so that is going to prompt the Fed to cut rates. Where I kind of disagree with Warren Pies is the sense of the Fed's going to be too late. Now, that's possible the Fed is too late, that there is a broader market kind of pullback, and, the economy gets damaged too much before the Fed reacts. I'm not certain that the Fed is going to be late to this one. I think, again, the Fed was late to, raising rates when inflation spiked. I think the Fed will be very fast to U-turn on the first real sign of weakness in the economy. Again, Trump is the president. You don't want to get on the bad side of Trump if you are Powell. Okay? And I really think the Fed can't afford to mess this one up. So I agree. Coming, April, May or so, you could really see some issues in the broader economy. I kind of see them today in my real life. As you guys know, I work in a restaurant, not because I have to, because I like to, because I like the people I work with. And I mean, psychologically, it's good for you, right? I'm a single dad of 2 kids, and I make stock market YouTube videos. The last thing I want to do is sit inside 7 days a week and, talk about numbers and stocks. And I love doing that, and I love my children, more than anything else in this world. But it will do something crazy to you psychologically if you do not get out and socialize. So long story short, that's why I do that, and sometimes I make videos there. But long story short, I've seen the restaurant industry as a whole really start to slow down, even ever since Christmas. And I know there's the hangover effect in January and sometimes in February, but now we're almost heading into March, and it is incredibly slow. And you hear this from everywhere else. So again, I don't think inflation is going to be the issue that I think a lot of Wall Street currently thinks it will be. Okay, so one, inflation, not an issue. I think the economy is going to weaken further from here. Okay, I don't really think company earnings are too at risk here, at least for now. But I do think you will start to see some weakness out there. I mean, it's going to be pretty hard not to, with a cutback in immigration, 250,000 government employees so far that have reportedly been laid off, and Doge cutting back on government spending. It's almost impossible not to see a further sell-off. And I don't think inflation is going to be so sticky and so stubborn and problematic that the Fed sits on their hands for too long and gets it wrong. Now, I also think with Scott Bessent being the Treasury Secretary, he is the perfect guy for the job. Like, there is nobody better than Scott Bessent for the job, because Scott Bessent worked on Wall Street. And as he has said many times now, the government really wants to focus on getting the 10-year treasury yield lower. So not really bullying Powell, but getting the 10-year treasury yield lower. That is by cutting back government spending, by, really reducing the deficit. That is what has driven 10-year treasury yields higher in recent months. It has nothing to do with what the Fed is doing. Although short term, the Fed's actions can definitely influence 10-year treasury yields. Now, on Friday, we had retail sales that came in lower than expected. And there's actually another clip on CNBC. If you guys want to watch it, I will point you in the right direction here. I'll show you what the clip is because I've already watched it. But I think it's also another good one to look at. It is this one right here. Newberger's Berman's John San Marco talks the downturn in consumer spending. I mean, this clip only has 935 views. Of that, I was one of the ones that watched this. Okay. He does go on to say that it's not super alarming what we're seeing right now, that usually January you do get kind of a lull from Christmas, but there is more than expected weakening in consumer spending behaviors. And, that does to me look like what's happening in the economy. Now, again, I don't think this is necessarily going to be bad for stocks. I do think 10-year treasury yields come down, the economy weakens a bit, earnings season continues to come in okay, and really there's a broadening out of this earnings season. I think markets can do just fine. I think markets can actually do really well as long as that 10-year treasury yield continues to come down and inflation does not continue to rise. Specific areas I really like this year. My number one area this year is AI software. Now, we all know semis are going to do well. They have done well, and that's pretty well priced into those companies. AI software benefits from the second tier or second derivative, as Dan Ives would say, from semiconductors. Semiconductors were the first to have, the AI benefit. It's AI software. There's 4 names that I really like for this that I'm personally invested in. Nebius, that's my number 1 pick right now. Number 2 would be Applied Digital. That is a data center name, so not as much software, but data center as well. I like MongoDB, and I like Elastic NV, okay, or just Elastic. Those are the 4 names that I really like for this year, with Nebius being number 1. Obviously, NVIDIA just disclosed a stake in them. We've talked about them here on this channel many of times now. That's my number 1 area. I like small caps as kind of a general thing, but not super small caps, like 10 billion, 20 billion, 5 billion, not 200 million, right? Not companies that have a terrible balance sheet, right? You still want to be selective in the small caps that you own. I don't want small caps that are going to be thrown off by any weakness with the consumer. Right? So I think you want to be specific with your small caps, more like mid caps, I guess you could say. 10, 20 billion market caps, 30 billion market caps, maybe. That could be a good area to look at. I also like cyclicals. I also like companies that could benefit from inflation coming down, from a consumer that could recover. Now, what I mean by that is like lower middle income consumers that could start to breathe a sigh of relief as inflation comes down. Okay, I like the Dollar Generals out there. I know that sounds crazy. As one example. So those are the areas that I like. I also like healthcare and biopharma. Believe it or not, biopharma does really well as 10-year treasury yields come down. So like a CRISPR, really like CRISPR right now for really the long term. Those are some of the areas that I'm personally looking at and investing in. Tesla. I think Tesla, believe it or not, after this fall is going to do really good. There's a lot of things doing right at Tesla. And I think if you are a Tesla investor and you're watching this video, you should know that I really like Tesla this year. Probably not a huge surprise to some of you, at least. So these are kind of my thoughts. Economy's going to weaken a little bit. The Fed's going to respond. They're going to cut rates while the government focuses on bringing down 10-year treasury yields, reducing waste, which kind of feeds into a weakening economy, which feeds into lower inflation. As long as earnings continue to hold up, which I think they will, the AI story continues to hold up, which I think it will, and the Fed doesn't make some kind of dire mistake, I think markets are going to do really well. And we're going to get more cuts than expected. 10-year treasury yields are going to come down more than expected, and that's going to be really positive for stocks. And just briefly, for anyone that does not understand the correlation between treasuries and stocks, it's pretty simple. As 10-year treasury yields pay you 4.5%, there's not a lot of appetite to go out and take risk, okay? You don't really have to. Once you are to a certain level of net worth, it's not really about growing it anymore, it's about preserving it. And what better way to preserve net worth than a 4.5% yielding treasury? Okay, great. Well, if treasury yields come down to 2% or 2.5% or even 3% or 3.5%, it's a lot less appealing to own those names. So high quality 5-6% dividend stocks become a lot more attractive as treasury yields are now at theoretically 3%. So dividends can start to do really well. Small caps with, small caps, cyclicals, a lot of stocks that have been beaten down can start to recover a bit as some individuals say it's worth taking the risk now because I can't get paid as much in 10-year treasury yields. That's really where the whole treasury yields come down, stocks can get a boost up comes from. Now, again, I'm not as bullish on Mag 7, so I think any rally we get in our markets is probably going to be, in 2025 at least, a real broadening out kind of rally. So we'll see. I think that could keep the headline S&P kind of tamed this year. But that's just my personal opinion. Let me know what you guys think about all of this information and down below in the comment section. Have a fantastic weekend, and I will see you in the next one.